It's 2025, and with that comes obviously a whole whack of new taxes that we as Canadians need to be aware of. Specifically, in today's episode, we're going to be talking at length about the new BC anti-flipping tax that came into effect on January 1st. That's a little Happy New Year gift from the BC NDP party. And of course, we're going to talk about some other federal taxes that you should be aware of leading up to it. So make sure you watch all the way through the video to understand what the tax changes are going to be and how they're going to affect you moving forward through 2025. Welcome back to another episode of Manning Up After Dark on the Manning Up on Real Estate podcast. And yes, we are talking about taxes today. There's a lot that's changing in regards to taxes, and a lot of it could impact you, especially if you're an investor, a business owner, or anyone who's looking to make any sort of profit in this country. So we're going to be covering the most important ones that you should be aware of that's likely going to have an impact on you. We're just going to rush through some of the major ones that you should be aware of, and we're going to spend the most time on the BC speculation tax. So as I said, keep watching all the way through so you understand which ones apply to you. First and foremost, let's talk about the first one, which was actually a little bit of a holiday that the government had done. Started actually in December, on December 15th, was the HST Holiday. That is still in effect and will go to February 15th. Now, the interesting thing about this one is a lot of companies are not actually participating in this. They actually made it a choice whether you are. However, I have seen signs at local restaurants and everything saying they are exempting you from the GST at this time. Sometimes when I look at my bill, I'm a little surprised not to see the GST tag on there. This is a little guise, because while they're giving you this holiday, they've also, like I said, added a whole bunch or changed a whole bunch of taxes that you need to be aware of. So we're now going to really dive into those ones. The first major one is that they've changed capital gains. They're going after more of your hard-earned money in your investments. And they've done that by changing the capital rate from 50% to 66%. They're going after 2/3 of your capital gains, anything that's over $250,000. So be aware of that one. If you guys are flipping properties, you've got investments, you're selling a property that you've owned for 15, 20 years, there's going to be a major change. So make sure you have a conversation with an accountant on how that's going to impact you. So that way you can make sure you strategize your best ways to make sure you're paying the least amount of capital gains possible. One of the best things that any investor can do is not sell property. If you don't sell, there's no capital gains. Instead, find ways to leverage that property because there's no tax on debt and you can buy other assets using that money. There's also a transition to the Canadian Entrepreneurial Incentive, which is an incentive that they're trying to push for more people to start businesses and entrepreneurs. I don't know a ton about this one, so make sure you do your research, but essentially it's going to make things more complicated when it comes to capital gains because there's some exemptions for people who are running businesses and around your shares, and yet there's still capital gains tax, but there's inclusions and exclusions. Make sure you talk to your accountant on this. It's going to make things way more complicated. They're trying to show it as an incentive, try to get more people to be a little bit more entrepreneurial here. And of course, it wouldn't be a new year without an increased attack on the war on climate change, as Trudeau's carbon tax is going to be increasing. It will be increasing on April 1st, so you can probably expect things to get a little bit more expensive out there, especially when it comes to oil and gas. Of course, the Trudeau government has to keep up its barrage to make sure we get climate change under control. And the best way in his mind to do that is to tax everyone. So prepare for more expenses there. They're also going to be changing how much you contribute to CPP and EI on every single paycheck. So they're actually going to be increasing that. So your take home is likely going to be a lot lower. It's also going to be increasing on your employer as well. So that means you can probably kiss any raise that you were hoping for goodbye, because now your employer has to contribute even more to CPP and EI along with you. When you start to look at your paychecks and you start to see that they've actually gone down a little bit, be aware that that's because they're increasing the amount you're contributing to CPP and EI. In terms of TFSAs, they've actually kept the cap the same at $7,000. So they don't even allow you to put more money into TFSAs to be able to save more money and earn a little bit more money interest free. They've capped it still at $7,000 because again, they don't want you earning too much interest free. At the end of the day, they want to charge you on capital gains as much as possible. Let's talk about the biggest elephant in the room when it comes to taxes. And this one is more on the provincial side of things. That is the BC anti-flipping tax. The BC anti-flipping tax takes effect January 1st. So a couple of days ago at the time of recording this, again, as a provincial government, NDP New Year, we're going to start charging you guys if you sell your property under the 2-year mark. That's right. So if you hold a property and you sell it anywhere before 730 days of ownership, you could be subject to this tax. Now, there are some exemptions in which we're going to go through, but let's talk about what this tax entails. So how it works is if you own a property for less than 2 years and you go to sell that property, you could be subject to this tax. How it breaks up is that in the first 365 days, if you sell that property, you have to pay a 20, that's right, the big 20% tax on any profits that were earned. So for example, if you made $100,000 in 1 year, let's say the market went absolutely fucking crazy, you would be basically penalized a $20,000 bill for making $100,000. And this does not include any federal flipping tax that you have to pay. This is completely separate. This is the BC only flipping tax. Then if you own that property from 366 days to 730 days, it's going to be on a moving scale downwards until 0. Any property that is held for over 2 years will be exempt from paying this tax. It sounds pretty scary, and it absolutely is. So who's affected by this? What are some of the exemptions? Well, basically any property owner is subject to this, unless there is any sort of life circumstances, let's say death, divorce, job change, anything like that. There are exemptions for people who are builders. If you're building a property for the purpose of adding more units out there, more available housing, you are exempt. There are also some exemptions for my flippers out there if you do this strategically, where you can actually be exempt as well. If you do a massive substantial reno, for example, what they show on the internet is, let's say you buy a house and you've replaced the roof, you've torn out walls, you've redone all the flooring, changed the floor plan, added more space to it specifically as well. Like let's say you've added maybe a basement suite, or you've added an entire another level on the top of the property, you could be exempt from the tax because that's a substantial change and you're making more properties more available to more people. The other thing that you could be exempt from is if you, let's say, add a coach home or anything like that. Again, you're adding more suites. So if you're increasing the overall density that property gets. Now, if you're a flipper out there and let's say you buy a condo and you change the kitchen, you change the flooring, some trim, some paint, you put it back up on the market, you will be subject to that tax because that is not a substantial enough renovation. So if you guys are going into properties, you have to think either one, if I'm not going to be doing a substantial renovation, I have to be prepared to pay that 20% and build it into your numbers. Or two, you have to have a plan that you do enough of a renovation that gets you out of that 20% if the numbers make sense. Of course, with any investment, it all boils down to the numbers when you're actually buying these properties and flipping them. Now, what about pre-construction? Well, pre-construction, you are subject to paying this tax as well. Again, on top of any other federal tax. How it's calculated on pre-construction is at the time in which you put your deposit down and the contract becomes firm and binding. That means that if you purchase a property, let's say January 1st, 2025, and you flip that contract within a year, let's say November 15th, 2025, you would be subject to that tax. Now, the next person who is purchasing your assignment, their 2 years starts on the day they purchased the right to purchase that property from you. So their 2-year time frame. So it's based on the contract. It's not based on when the property is actually complete. Now, that's very important to know because that might change some of your pre-sale strategies. For example, if you're going out and buying in projects that are, let's say, a tower and it takes 4 to 5 years to build, well, that's probably going to be a little bit more safer for you because you know you're not even going to bother trying to flip it in the first 2, 3, or even 4 years. You're probably going to wait till it's closer to completion, meaning you're going to be exempt from that tax. If you're buying in the pre-sale like low rise or townhouses, you have a higher chance of it actually being under 2 years to complete that property. Now, let's say you close on that property. It takes like 18 months to build. You close on it, and then it's over the 2-year mark by the time from contract date to when you finally sell it as a resale property after it's been tenanted. You wouldn't be subject to this. It'd be over 2 years. So because again, it starts on your contract date. Now, it's very vital to understand that this does not go on your taxes. You are responsible at the liquidation of the property or the sale of the assignment to actually file yourself within 90 days. That's right. The onus is on you to make sure that you do your filing. You also have to file if you fall within some of the exemptions. If you're planning to pay zero because you are exempt, you still have to file if it's within 2 years. You only don't have to file when it's after the 2-year period. Now, again, don't quote me on that because things might change, but it's very important for you to understand that if you don't do the filing, you could be in breach of this tax and they could come after you for this. This is a huge change when it comes to dealing with liquidation and offloading properties here in British Columbia, and it's going to change the game. Now, this is one thing that I think is going to happen. When you've got people who are out there flipping properties, they are buying, they're renovating, they're increasing the value of a property, and then they're selling it. Again, they're going to be building in this increase in taxes that they're going to have to pay into their profit margin. They're going to be looking to get a higher price. Now, again, the market does determine what the price of that property actually is. However, if enough people are now adding that in and they're expecting a certain threshold, this could bring up property values here in BC. Anytime people add taxes to properties, all it does is make things more unaffordable, and people find ways to get those taxes covered by the next person, by the buyers. So at the end of the day, we're trying to make things more affordable, and we're probably going to have the opposite effect. That's just my opinion. We're going to watch to see how this plays out. But there it is. There is the new taxes that you have to be prepared for in Canada, and specifically in British Columbia when it comes to buying and owning properties anywhere in this province. You have to be prepared to hold that property for a long time, which at the end of the day, if you're buying properties, the best strategy for long-term wealth is the fact that you use the word long-term. Hold it for longer than 2 years. You don't have to worry about this. You hold a rental for 5, 10, 15, 20 years. You'll be totally okay. They'll probably come up with 19 other taxes by the time you go to sell the property. But if you are someone who does speculate in the market, you do flip properties, you buy pre-sales and sell assignments, be prepared. This is going to impact you, as well as any other change that the federal government has recently done as well. Again, capital gains tax changes, all these things that you have to be aware of. So make sure you have a conversation with your accountant while you're making your purchasing decisions to make sure you structure yourself the right way to maximize any tax strategy that you possibly can to save yourself some money, because it is getting expensive here in Canada. They tax literally everything. And I bet at some point they're going to just be taxing every little breath that you take. There's a cent. With that being said, thank you guys so much for watching or listening to this podcast episode. I hope you guys have a fantastic 2025. And regardless of how much they're changing in taxes, there's still a ton of opportunity out there for you guys. So go out, find that opportunity, make money out there in the market. If you need any guidance in the Greater Vancouver market, we are here to help you guys. Subscribe to this podcast either on YouTube, Spotify, or Apple. Like this video and comment below. What are your thoughts about some of these taxes? And we'll see you guys on the next one. Take care.